Welcome back to Smart Trader Talks, the podcast where we decode trading one episode at a time. I'm Sarah, and with me is Mark, our resident expert from CMTrading.
Hey everyone. I'm really excited to dig into today's topic. It sounds super important. Lots, pips, and spreads. But what exactly are they? Laughs.
Absolutely. These three concepts are the basic units of trading, Sarah. Understanding them is essential to grasping what's happening in your account.
Okay, that makes sense. So can we start with lot? What does that mean in the trading world?
Great question. A lot represents the size of your trade. In Forex, one standard lot equals 100,000 units of the base currency. So if you open a one-lot trade on EUR/USD, you're actually trading 100,000 euros.
Whoa, that sounds massive. Who actually has that kind of money just lying around? Can you picture someone casually tossing around $100,000? Laughs.
That's precisely why leverage exists, Sarah. With leverage, you don't need the entire amount. Just a margin. Plus, there are mini lots, 10,000 units, and micro lots, 1,000. It really opens up your trading options.
Oh, so I can trade smaller amounts too? Is it possible to trade with just a handful of bucks?
Absolutely. Most platforms allow you to select lot sizes down to micro levels, meaning you could trade with just a couple of $100s.
Okay, cool. Now what about pips? I've heard that word thrown around so often. Confused. What are they exactly?
Pips are crucial. It stands for percentage in point. In most currency pairs, it's the fourth decimal place. So if EUR/USD moves from 1.1000 to 1.1005, that's a movement of 5 pips.
That's interesting. But why do we use pips instead of just measuring profit in dollars? Isn't that a bit odd?
That's how you actually measure profit or loss, Sarah. For example, if you buy EUR/USD at 1.1000 and sell at 1.1010, you gain 10 pips. The value of each pip varies based on your lot size.
Can you give me an example? I'm still trying to wrap my head around this whole pip thing.
Sure. With a standard lot, 1 pip is worth $10. So if your trade moves by 10 pips, that's a profit of $100. With a mini lot, 1 pip is worth $1, and with a micro lot, it's 10 cents per pip.
Wow, that really clears things up. If I dropped out of college and just went for trading full-time, is that a realistic idea? Laughs.
Haha, well, most traders gain skills first. But yes, trading can be very lucrative if approached correctly. It's all about risk management and understanding these essential terms.
Okay, and what about spreads? They sound sort of scary, like a margin call or something, but also, less terrifying? Is that right?
The spread is actually the difference between the bid and ask price. When looking at a currency pair, you see two prices, one to buy and one to sell. The spread represents the cost of entering the trade.
So I start off my trade at a loss already? Ugh, that's a bit discouraging. Why do brokers do that?
Exactly. So if the bid price is 1.1000 and the ask is 1.1002, that's a 2 pip spread. You open a trade and you're down those 2 pips from the get-go.
So, I've already paid the spread before even considering profit or loss? That's a lot to take in.
Correct. Some brokers have fixed spreads, while others are variable, especially during news releases when spreads can widen.
Okay, to wrap things up, a lot is about trade size, a pip measures movement and profit or loss, and the spread is the cost to open a trade. Did I get that right? Laughs.
You did perfectly. Understanding these three concepts gives you a significant edge over most beginners. Seriously, it's a game changer.
Thanks, Mark. That was a ton of info to digest, but totally worth it. Who knew that trading had such a structured language?
Glad to help, Sarah. It's all about making sense of this fascinating world.
We'll catch you all soon with our next episode, where we dive into how margin works and what a margin call really means. Don't forget to follow CM Trading for more episodes, and as always, trade smart.